Welcome back to Inside Options. Joining me again is James Bolton from the JSE. James, we were talking about derivatives in the first half.
Yes.
They've received some bad press.
Yes, they have. And it's quite fascinating. I was chatting to a friend of mine who works for one of the big banks. He was looking for his boss. Let's find some good derivatives, good news stories. Problem is, they don't make the press. Around the world, trillions and trillions of dollars trade every single day in derivatives, and nearly all of them help to make businesses' future input costs and contracts more certain. They sort of create certainty in this uncertain world, and that's really what derivatives are for. And the press tends to jump on the one or two stories where it's sort of really quite negative and really publicize those. It makes a great story. I mean, I know me as a reader, as a consumer of news, I'm like, wow, this is an amazing story.
Disasters,
sort of derivative disasters, reading about these scary things that happen. Nearly all the time, that's not really an accurate reflection of what's actually going on in the marketplace. A big part of it is there are two main types of derivatives. There are two main categories. Let's say one is over-the-counter, and that's sort of bilateral deals between a bank and their customer, who's usually quite a sophisticated company, like a multinational company or a big local company or another bank or an asset manager. So that's a bilateral deal that these two people will then trade, and those are governed by ISDA agreements. Now, ISDA is ISDA, and that stands for the International Swaps Dealers Association. It used to be SWAPS, it's International Security Derivatives Association. They've changed it a little bit. So it's quite interesting to see sort of the difference between that, and then the other kind of derivative is on-exchange traded. Now, on-exchange trading brings a lot of benefits.
It's regulated.
I do work at the exchange, so that I'm very biased towards it, obviously. But it is regulated, it's more transparent, and you're also not sort of a captive audience. You're not stuck in a deal with one party. You can actually trade the same instrument with anyone else.
Are you saying that most of the disasters that have been reported on, as far as derivatives trading has been concerned, have been due to OTC trading?
There have been, I think, more. Although the market is much bigger, so probably proportion-wise, it's probably around about the same. And a lot of the people sort of get caught out at the same time on exchange and over-the-counter stuff. So we saw with sort of CFDs and single stock futures around 2008, people were geared in illiquid stocks. So both guys, the over-the-counter guys and the on-exchange, both suffered losses, and it was kind of a scary time.
On the subject of risks, James, can you take us through some more of these risks? I know there's a valuation risk involved.
Yes, so valuation risk is quite interesting. It comes up quite a lot in derivatives, and it's something we've been working with some auditors, sort of just occasionally keeping the lines of communication open, talking about some ways to value some stuff. And a part of it is that derivatives are uncertain. A lot of their forecasting is required to forecast what will happen for the price movements. I mean, we've talked quite extensively about implied volatility. Now, that's quite an interesting number, and basically you can tweak that number fairly reasonably with a decent argument behind having that number where it is, and get quite different values for the same instrument. So in one case, we actually were talking to auditors and guys at two big banks in South Africa were trading against each other. They both were showing quite good profits on the same trade. Now, basically, on that particular trade, it's going to be a zero-sum trade. One of them was right, one of them was wrong. But they both tweaked the volatilities up a little bit here and down a little bit there, so both of them were showing big profits, which can't be correct. Problem is, there's a reasonable argument for both of those values, so it does get a bit subjective. And that's where it's quite nice that to have on-exchange traded stuff is that those values, you can see where we're valuing them, you can sort of talk to us about why we're valuing them there. You can see all our inputs, and you can then compare them to other people's valuations. So it's independent, and you automatically have that independent valuation. Now, in over-the-counter trades, often one party, usually the bank in the deal, will be appointed the calculation agent. So they've got to calculate that price. Now, there's a risk there that they won't have as independent a check on it, but I mean, that's what the bank's risk department's there for. That's what they've got to do, and generally they're amazingly good at valuing very complicated stuff. Also, a lot of independent valuation services that they'll help them to look at those things, and they've got to hire those guys to say, hang on, are we right on this number? It's quite meaningful, there's big money riding on it, and that's valuation risk. So on exchange, it's a bit easier, it's a bit more transparent, and there is an automatic third party. I mean, worst comes to worst, we could call it another third party.
All right, we have 30 seconds left, James. What is the JSE's vision of the exchange trading future for every day for your average Joe?
We want electronically accessible markets, well understood, with a great education program that people can learn about derivatives and start to understand them and not be so afraid of them, and know that they can manage some of their risks and trade these products easily.
We'll leave it there. We'll pick up again next time. Thanks very much for joining us. That was James Boardman from the JSE's Equities Derivatives Division. See you next time on Inside Options.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.